Morning, everybody. Would like to introduce my colleagues, Susie Woodstock and Brett Plumley. I'm Ken Nordhoff. We are all principals that work on the sales tax team. We work extensively with many of you and your agencies that are on this call, as do our colleagues. And so we're very grateful that you're here. We're happy to share information, and we're most interested in getting some feedback as we go. So do not hesitate to ask your questions. I think most of you know about our company. We've been around over 40 years. We exclusively work in local government. We have a very high concentration of business in California. We're very proud of our high client retention rate, and we've been able to generate a lot of revenue through audit, analysis, forecasting, and other efforts over these last 4 decades. So just a little bit about our company. And then I'm going to move right into starting to share some information. So today's webinar will be a bit of a hybrid of sharing out some quarterly results. This is the high level information. What Susie and Brett are going to do over the bulk of this morning is go through the 8 industry groups and present to you both what's occurred in this first quarter of 2024, which, if you're not familiar, or as a reminder, that's the January to March sales tax period. I'm going to talk a little bit about just some high level results for this quarter. And of course, we'll be laying out our forecast, both overall, as well as breaking that down by the major industry groups. This particular period, we saw a very nominal decline in first quarter 2024 results, down 0.2% compared to the same data of the prior year quarter, 1Q23. And that was very close to the estimate that we had put forth back in March, which was down 0.7%. A couple of areas that we're going to drill down on and have more information, but a couple of areas that maybe moved in different directions more so than we anticipated were autos and transportation. And Brett will talk about that. Had a pretty rough quarter. Susie's going to highlight some things under business and industry, which actually had better performance than we anticipated. And then, like we typically see in the data, the results as we start to look at things regionally looks very different. So you can see on the right here, some of the rural areas actually had some better performance. Concentrated urban areas like the Bay Area numbers were actually down a little over 2%. So, you know, while this is statewide data, obviously local results to your agencies will vary. So just some considerations that we look at as we're building out our forecasts, and this is a process we go through with our team every quarter. Here in these 6 categories, you can kind of see the boxes are shaded in different colors. So we're more concerned or cautious or aware that some things that may be having a negative or a more negative outlook would include things like interest rates, household costs, and credit availability. Consumer spending is a little bit of a mixed bag. We do see some positive things. Gas prices, particularly from the revenue generation perspective, which Brett will get into, and then tourism and business travel is also on the uptake. So let me run through some data points here that I think will be helpful, underlying really the overall themes. One that's most prominent and has been for quite a while is interest rates. So this is a chart looking at the Fed funds rate. You can look back, if you can't read that, it looks back prior to the 2020 COVID year, and interest rates, even at that time being in the 2 to 3% range, were still very good from a long-term historical perspective. Money basically got free for a couple of years once the pandemic unfolded, and then the Feds, realizing that inflation really took off starting in 2022, have bumped the borrowing rate 11 times since March of 2022, and that has landed at a 525 basis point level that has been in place almost a year, since last July. So that's certainly a factor. We have a chart here identifying goods and services. And so the information related to inflation that's most current, we see that the year-over-year numbers in May were up 3.4%. What's happening here, the core goods is this dark line here, and that would be the tax generating piece largely. That has been in decline for a good part of this calendar year. Services have actually improved. So people are choosing to spend more money in areas that may not be generating tax revenue. And I'll talk a little bit more in a minute, but we've introduced this idea of shelter. So household costs, mortgage, rents, utilities, insurance have definitely been rising. And that's certainly also having an influence on the outlook of where spending may be going. Next chart here is dealing with personal income. What is disposable? Again, that's the darker line in this graph. And then consumption expenditures. And the most recent data, maybe a little hard to see right here in the corner, but expenditures have begun to grow faster than income. And that is going to have potentially a weakening purchase power effect on tax revenues going forward. Consumer credit. Again, with kind of looking through recessionary periods, but getting past that, we've definitely seen over the last few quarters a tightening in lending practices. So as the levels of delinquency have risen, and when I say that, I mean not just credit cards and auto loans, but even things are creeping up around mortgages and HELOC loans. That is tightening the amount of available money. And so the willingness has really nosedived, and the amount of credit that is available has also started to contract. Again, an influencer on consumer spending patterns. This chart, which I think many of you have seen before, is looking at personal savings. Again, looking back, maybe a decade ago and the ensuing years, running in the 5, 6, 7% range. The fear and concerns with the onset of the pandemic really drove that up. And then as the economy reopened, those numbers have fallen way back down. So to the extent people had that money, they've used it up. The low point of that savings, again, was back in 2022, but in this current quarter, sitting on about a 3.8% rate. Pretty low, not much room for emergencies, and certainly not for thinking through discretionary spending. So here's a couple of things on insurance, and you all live in the state, so you understand what's going on if you own a home or a car. The line graph here on the left is illustrating just how much the annual cost of car insurance has been driven up to some extent by litigation, and there's other factors. And then on the right here, there's been just a fairly dramatic shift in the home insurance business. Some of the companies that used to write a fair number of policies have either pulled out or limited what they're writing. Those costs of those premiums have gone way up. On an average 15% over the last year. And so these dollars are all eating away at what's available in households for spending on sales tax generating items. Unemployment remains actually very good. It's not as low as it was. It bottomed out back in August of 22, sitting at about 5.3% as of April. Of course, peeling into that, you would find, different sectors are having different outcomes. There was some expansion in areas like hospitality and medical and even government, but there's certainly contraction in other areas like the tech sector. And on the left here, we're just breaking down what this looks like when you look at this on a county by county basis. Numbers really along the urban or highly populated areas tend to be more in line with the state average. Some of the rural areas are still struggling with higher unemployment rates. This is how the sales tax data looks comparing the 3 quarters of fiscal year 23-24 back to calendar year 23, and just trying to give you an overall indication, again, on a county by county basis of areas that might be doing better. That would be green, and the darker the green, you can see there's greater than 4% comparative performance. And then in contrast, in the orange areas, there's been more dramatic declines. And so although the results for the quarter were fairly flat, numbers are still down, comparatively speaking, but that's not a consistent outcome everywhere. And certainly, and you'll hear more about this as we talk about some examples of data like in fulfillment centers where we have concentrations of those types of businesses. It tends to be helping some of the county results. So just the overall statewide trend, this is a look back. You can see kind of post-COVID, some really strong quarters, and we've gone now through several periods in the calendar year 23 of negative comparisons or contraction. And this is the current quarter. And the outlook here is fairly modest. You're going to expect to see an overall reduction this year and some improvement next year. And we're now going to walk through that in some detail, and I'll be back to summarize after we get through all the industry group presentations. So I'm going to hand this over to Brett.
Thank you, Ken. Appreciate that. And yeah, we're going to start talking about the major industry groups with the first one, autos and transportation. And this, as Ken mentioned, sector was hit the hardest in the quarter, down almost 7.5%. We highlight here, as Ken did highlight, overall trends statewide in the particular industry. The green are positive factors, so more upward pressure on sales tax, and inventory is picking back up. Dealers are starting to offer more incentives, and that we think will eventually lead to, it's a more balanced market, eventually leading to a buyer's market, which is a positive thing. Overall, on the red side, more downward pressure in this particular quarter, and highlighted on the lower left there, lower prices literally translates to lower sales tax. So we have had prices coming down over the last several quarters, and that is the primary factor for lowering overall sales tax in the sector. We have a chart that I'll show you in a moment that demonstrates some of the segments that have been coming down over the last couple of quarters. The increased leasing activity that we're showing here, we have it as a downward pressure. It's starting to pick back up. We know that leasing as a business type has been hammered down pretty significantly post-COVID and even ongoing a year and a half so later. It's picking up, but increased leasing activity means that that is spread out over a period of time. So you're not going to get the initial sales tax all at once. And we have it as overall a downward pressure. Ken mentioned credit. So the lower access to credit, it's been significantly hampered now, much tougher to get loans. The high interest rates, the Federal Reserve has not lowered the interest rates, and Ken showed you that chart. We're all aware of it. We had anticipated several drops in this particular quarter that would have a positive impact on autos and transportation, and it just didn't materialize. The dealership software hack that we're highlighting here is happening real time. It's not something that we've included in as a material impact overall on our forecast, but we wanted to talk about it. Dealers are being really hampered by this hack that's taken place. They do so much through automation, and they're not able to do that. And I don't really think that there's necessarily a lot of backup old-fashioned systems writing it down pen and paper. So that is definitely having an impact, and we wanted to mention it today. This one is auto inventory, and it's been coming down. It's been down pretty significantly during the pandemic. But the good news here, as you see at the tail end here, kind of flattened out at the bottom of 22 and has been picking back up. So positive factor in terms of eventual recovery of this sector. Auto costs here, we're highlighting, we say roller coaster. You can see all over the board different factors, but the main one, it's a little tough to see, but that red is auto insurance, and those costs have been skyrocketing recently. So that is having a negative impact overall. It's another factor for the decrease in this quarter. I mentioned the market segment that we've been analyzing for the last several quarters, luxury vehicles, which include Mercedes-Benz, BMW, Jaguar, those types of vehicles. You can see we highlighted 2 quarters here. The most recent quarters are on the left side. The right side over here is that history. So we're wanting to focus in first quarter 24 and really fourth quarter 23. Luxury vehicles down double digits, really 3 quarters in a row. Asian market has started to stabilize the last couple of quarters now. It was down only 1% in the fourth quarter and flat in the first quarter of 24. And that's Toyota, Honda, Kia, Subaru, those types of vehicles included in that particular segment. And then domestic also down significantly. Fourth quarter was down 8% and double-digit decline there with the domestic vehicles, Ford, Chevrolet, Chrysler, Dodge, all included in that category. So primarily the reason we have this here is because we want to show another combined factor for why the sales tax is down in this particular quarter. Here's the auto financing. Ken highlighted the credit availability difficulty in every area right now. And in auto financing, it is definitely having an impact, a negative impact overall. Dealers are, lenders are much more restrictive in approving loans. And the main thing here is the index is down below 100, and the financing that has been allowed and approved has dropped 0.7% year over year. Overall, in the forecast, we're highlighting in red the first quarter of 24, the one we're talking about today. So that 7.5% drop that I mentioned in comparison to 4% that we had forecast. So worse in the quarter, primarily the lending, the Feds not dropping the rates had an impact, and prices. Those are the main 2 factors. As a result, we've also taken down fiscal year 24-25, pretty flat, but down negative 0.2%. We had that a little bit more than 1% growth in last quarter's forecast. Good news is we're continuing to project recovery in this sector as we move forward. So we haven't changed our forecast in those out years, 25, 26 through 28, 29, and we have 3.5 to 4% growth in those years. Now we're going to talk about fuel and service stations indicators, and again, the red being the downward pressure, the green is the upward pressure, and overall prices are down. And we're talking about, when we talk about downward pressure, mainly focusing in on fiscal year 24-25 in comparison to 23-24. So fuel prices, jet fuel, regular gas, down compared to a year ago. Same with oil barrel, that's also down. The California supply of fuel is up, and that was talked about in last quarter's webinar. Ken Brown highlighted it. That's a positive factor when it comes to consumers, but it's a negative factor when it comes to the sales tax that's associated. The U.S. demand is beginning to slow, according to Gas Buddy. That's downward pressure. Overall, California consumption is down. I've got a chart that I'll show you in a moment that reflects that. And then the world supply of oil is being held by OPEC through the end of this calendar year and on into the first quarter of 25. So that's upward pressure overall, increased pressure on sales tax, kind of offsetting these otherwise drops. The worldwide conflicts are still in play. And then California refineries recently hurt by legislation that is impacting their ability to create a profit. So that could lead to increased prices and restricting the supply. There's 15 main refineries, and if they start to move out of the state of California, that's upward pressure on pricing. This one now is gas prices. The good news, we want to highlight good news here. So we are focusing in on the second quarter of 24, and it's up. Prices were up 7.7% compared to second quarter 23. So that helps out our fiscal year, your fiscal year 23-24, a little bit better than what we had projected. So a piece of good news in there. The consumption that I'm talking about, I mentioned motor vehicle fuel makes up more than 80% of the total. And you can see here, we're highlighting, it's a 4-quarter comparison over a period of years. And mainly you can see the drop in 23 and 24 that is happening, flattening out and dropping. the right side, same picture in the first 2 months of calendar year 24, which is the most recent data that we have on consumption. So downward pressure there. Overall forecast in fuel and service stations, 2.3% drop. We had projected 1% growth. So we missed that one, down mainly because of those factors, prices coming down in the red in the trend that I was just talking about. And as a result of the downward pressure, we've taken fiscal year 24-25 down a little to 1% growth, fairly flat, and then picking back up consistent. We haven't changed our forecast on those out years. We have 2% growth projected, 25-26 through 28-29. Now we're going to talk about building and construction as a sector. And the story here in this quarter, fairly flat. The positives are in green, and lumber did really well. Lumber's back in demand. We have a chart that we'll talk about related to that particular type of purchase. Contractors, which is a business type within building and sector, they were up as well, and as evidenced by growth in cement plants. Infrastructure projects are now beginning to launch. They've been delayed. We've been talking about a delay. We've been hoping that they've been coming in and would help out the overall sector, and now they're starting to hit. So that was a positive this quarter. On the negative side, 2 of the major home improvement stores in the state were down pretty significantly. So that really is the primary factor for flattening out the results this quarter. Housing development, interest rates are high, mortgage rates are still high, starting to come down just a little bit, but development, new starts are slow, and rooftop solar residential permits are not being issued nearly as significantly as a year ago. The incentives have gone away at this point, so that's a downward pressure overall. Lumber prices all over the board, as you can see. In this case, we are highlighting second quarter 24 because we wanted to point out, if you see just the right side, a little bit of good news with those prices coming back up, and that's going to help solidify the sector overall. Ready-mix concrete, I mentioned contractors did well. This is one of the particular types of purchases within contractors, and it's upward trend, good news, up 5.6% compared to a year ago, same quarter. Overall, in the forecast, flat, and actually better results than what we had projected. We thought it was going to be down real close to 1%. Actual results only down 0.1. We took down the forecast a little in 24-25 from 3.1% to 2.7%, and primarily because of the home improvement stores not doing as well and making up a pretty big percentage of the overall sector. The good news, consistent with what we have projected in autos and transportation, is we're still forecasting recovery beginning in fiscal year 25-26. So those out years, we need to get out to 25-26, get past the 24-25 flat year, and we're projecting growth of 4 to 5% in those out years. And the last one I'm going to talk about is food and drugs as a sector. This is one of the business types within food and drugs. We've been talking about it a lot with the drop going back to the peak, which was the post-pandemic big quarter, second quarter 21, and then ongoing decline all the way to the most current quarter, where it's still down 4.6% in the first quarter of 24. Overall forecast here, food and drugs, flat is the story. Flat is the story all throughout. So you will see a consistency, and you're seeing it. You'll see it as Susie starts talking about it, the other groups as well. And overall, Ken mentioned pretty flat for the complete total results. But in food and drugs, grocery stores were up a little bit, and that's good news. That makes up about half of the group. Convenience stores, liquor store sales, pretty flat. Drugstores, led by primarily closures throughout the state from Rite Aid, were down. And so mixed results. I mentioned cannabis was down, but overall flat in this quarter. And the story is forecast to be pretty flat in 24-25, 0.8% growth. ongoing, we haven't changed our long-term forecast, 2% annual growth in those out years, 25, 26 through 28, 29. And with that, I will hand it over to Susie.
Okay, thank you, Brett. I'm going to start with the general consumer goods. This is the brick and mortar stores that sell general consumer goods, not the online or the out of state types of general consumer goods. Those are in different categories, and I'll talk about those later. Of course, there is a variety of types of stores, and they can trend differently. So here we're looking at the percent changes for the subcategories, the business types in this general consumer goods group. The biggest business type is discount department stores. It is 1/3 of the general consumer goods group, and it was up 1.6% this quarter, pushing really the whole group positive. Family apparel had a wide swing from last quarter, driven by off-price concepts seeing increased customer transactions. Most other categories performed as expected. Electronics did not cool quite as much as we anticipated, but I believe we're close to the bottom for that segment. Housing conditions could be playing a role as furniture stores remain a weak spot, but of course, a lot of people did their remodeling over the last couple of years, so just not needing to furnish a new house as much right now. So taking discount department stores out of that and looking at the overall trend for the rest of general consumer goods. The solid line here, we're looking at these 9 impact categories. And we see in 1Q24, it came back to flat after 4 quarters of negative results. The dashed line is the forecast. The expectations remain for soft growth as consumer budgets remain tight, mostly due to service-related spending like higher restaurant costs. And other factors like insurance premiums, like Ken said, low savings rate, high borrowing costs are also concerns, but consumers have shown they are resilient over the last year. So we do have, going forward, the dashed line. It is positive. It's barely positive, but it is positive. The National Retail Federation's Retail Monitor shows consumers continue to spend. Again, we've got resilient consumers right now. There is stubborn inflation, but it's almost entirely in the service sector, which of course we'll look at in the restaurant slides in a little bit. Monitoring retailer guidance and expectations. The majority have held expectations stable in their 1Q24 reporting. Only a couple have slightly revised downwards, and you can see that Ulta right here decreased, and Macy's increased their lower end. Also consistent with the other data that we're looking at, you see Walmart, Costco, Target, all positive. That's in the discount department store group. TJ Maxx and Ross, these are the off-price brands, also positive. Department stores down, electronic stores down. So again, consistent with what we're seeing in the other data is what the retailer guidance is showing. So with all of that, our general consumer goods forecast, we had projected it at about down about 1.4%, but it actually ended up coming in up 0.5%. And again, the discount department stores and the family apparel both coming in stronger is really what's pushing that. Going forward, as we saw in those 9 impact categories and with the guidance from the retailers, that we have 1 to 1.5% growth going forward. Okay, now we'll move over to the pools. This is a group that has a portion of the online general consumer goods. But you can see the pool is made up of several categories. Here's the general consumer goods. This quarter, it is the biggest category. We have a big portion is business and industry. Both of those were positive. Other portions, we have autos and transportation and building and construction. Both of those were negative this quarter. Restaurants and hotels, of course, most of the merchandise in the pools is coming from out of state. Restaurants and hotels is not a merchandise coming from out of state. It is delivery vendors who do not own the merchandise at the time it's purchased, but they are paying the sales tax on it. And so it ends up in the pool to the location where it is delivered. And you can see restaurants and hotels were also slightly up. Here, looking at a little closer, like I said, general consumer goods versus the rest of the categories in the pool. This slide is showing that the percent of change in general consumer goods is in teal and the rest of the categories in blue. General consumer goods had big jumps beginning in 4Q19 and continuing for those few quarters due to legislation and, of course, the pandemic with online shopping during when we were all staying home. Then in 4Q20, several online companies started using in-state fulfillment centers, and that shifted the reporting from this indirect distribution through the pool to direct allocations to the agencies where the fulfillment centers are located. Therefore, changing the pool, and we'll see that in the business and industry group in a little bit. There was another change in 4Q22. You could see it already had shifted that general consumer goods was lower than the percent change for the rest of the groups. And now in 1Q24, almost everybody in the pool is pretty close together. Okay, to further illustrate how in-state versus out-of-state is affecting the revenue flow. This top line, this is all general consumer goods for online shopping. The top line, the top blue line is the portion that's distributed via the pool method that we're looking at right now. And the bottom teal line is the direct allocation that goes to the location of the fulfillment centers. Again, that will show up in the business and industry group. Here we see that 4Q20 when it first shifted, and then we're seeing the other shift. So previously, pool allocations, previously online allocations were about 80% to the pool and about 20% to direct allocations. Now, after these shifts, we're about 60% of online shopping is being distributed through the pool, and 40% now is coming through the direct allocations as we see shifts continue. So overall for the pool, we had projected about 1% growth. It came in about 1.6%, so a little bit better. Overall for 23-24, we are still seeing that slowing consistent with most groups for that year. And then going forward, looking at about 2% growth. Again, a little bit slower, but still positive. Now on to the business and industry group. This is a big eclectic group, but the biggest slice is now fulfillment centers. And fulfillment centers are that last portion of the online general consumer goods. Here, this is items that are coming from in-state fulfillment centers. So the pool was coming from out of state. These fulfillment centers are located in California. The fulfillment centers are about 28% of our business and industry group right now. And of course, as mentioned earlier, we had some shifts in reporting. It went from the pools to these fulfillment centers. And so you can see the gray bars are the percent growth, the percent change, and you can see when those shifts have occurred, we have bigger percent changes as more revenue is reported this way, not through that indirect way. Okay, moving on from fulfillment centers now. There are about 21 business types in the business and industry group. It is a wide range from industry to farm equipment, to wineries, biotech, motion pictures. Here we're looking at the top 10 business types in the business and industry group without fulfillment centers. These 10 are about 51% of the business and industry group. You can see the medical biotech at the top was positive, but most groups were actually saw some declines in this quarter. The one thing overall, these 10 grew about 1.9%. The real reason for that growth, with so many of these categories actually seeing a slight decline, is this office supply and furniture group. And we believe that this is attributed to the expansion in AI, causing this big jump here. Looking at some of the considerations for the business and industry forecast, First fulfillment centers, again, 28% of this group. We're anticipating about a 4% growth moving forward for this e-commerce as it remains strong and in-state fulfillment centers grow. The ISM for the manufacturing index, this directly relates to our light and heavy industry categories. Those are the third and fourth biggest sectors in the group. If I bounce back here, you can see these two are quite high up on the list there. The index is contracting and high interest rates are hurting investments. We've already heard that for several other categories that interest rates are affecting, and it definitely is hitting this that manufacturing index. Medical biotech, that was the top of that last slide. This is also depressed by high interest rates, and the pandemic demand has diminished. The medical biotech group does have a hopeful outlook, though, as this is a ever evolving industry. And then the ag industry, another big part of this business and industry group. It has several moving parts right now. Technology is moving fast, and they are including AI into the industry. But also, this group is impacted by those high interest rates. Tractor makers are anticipating lower sales in this upcoming year. So rolling all those things together, we had projected about 1% here, and you can see it came in up 3.6%. So a little bit better than what we're projecting. Again, there are a lot of influencing variables for these various sectors. We had that one office supply group that came in much higher that really contributed to this big jump here. We expect modest growth overall for this diverse group. And you can see about 2.7% growth going forward. Again, this is such a unique composition that projections will really vary by agency to agency, depending on what is the most influential factor in your business and industry group. And finally, on to the restaurants and hotels group. I'm going to start just by looking at all the issues that are impacting this group. The overall concept is rising menu prices are causing people not to eat out. But why are those menu prices rising? Of course, operating costs have been continuing to rise. With that, they push those increased costs into the menu. To keep up with those rising costs, restaurants have been taking steps over the last couple of years. This is not new. They have modified their hours, increased their automation, changed their portion sizes, scaled down menu options. They are very cognitive of there is a point when prices get too high that people will not eat out as much. One of the other things they're doing that we're really seeing right now is they are offering value menus. They are trying to entice people to come in for a $5 meal and hope they'll buy other things that make their meals go up to $40. We've had menu prices for a while going up. What's happening now is we're seeing food at home starting to flatten out a little bit. Customers are frugal with their dollars right now, so they are eating out less. We have a few other things that are going to impact menu prices. One of them is SB 478, the junk fee ban. It goes into effect July 1st. So what this will do is that restaurants will have to roll these additional fees that you've been seeing at the bottom of your checks. They no longer can put them at the bottom of the checks. They have to be included in the menu prices. So again, when they take those off the bottom of the check and add them into the menu prices, that will raise menu prices. The other thing we have is AB 1228. This went into effect April 1st. So the quarter after what we're looking at right now. This requires fast food restaurants with 60 stores or more nationally to pay their workers $20 an hour. Of course, this is going to raise menu prices. Regular minimum wage in the state is $16 an hour. We did see some rise in menu prices in first quarter, and we think some of the restaurants were preparing for that implementation. We are starting to see closures of some restaurants more and more. A lot of the brands are saying that they are closing their underperforming stores. So here's a few of the closures that we've started to see. Again, we know menu prices have been going up for the last few years. At first, we did not mind so much. We wanted to support the restaurants right around here. Then we still wanted to eat out, so we didn't mind. And food at home, this red line, was going up way more than food in the rest than the menu prices were. So again, we still wanted to go out to eat, but now we're getting fatigued with the high prices. Again, we're trying to be more frugal with our dollars. And here the menu prices are still going up, and look at food at home is going up much less than the menu prices are. So this is again part of the problem, that the alternative is cheaper. Back here, yes, menu prices were still steeply going up, the blue line, but look at what food at home was. So it was shocking to go to the restaurants, but it was more shocking to go to the store, and we were still really enjoying eating out again. So rolling all that up, we had projected that 1Q24 would come in at about 1.6%. It came in at 2.1, so it came in a little bit better than expected. You see in 2Q24, when AB 1228 goes into effect, we don't have a big jump. AB 1228 is raising that minimum wage 25%. We are not raising the prices. Fast food, or the projection that much. Fast food is about 30% of restaurant and hotel group. And about half of that group will be subject to this new minimum wage. But again, we're kind of at that tipping point. The higher prices are going to be offset by less foot traffic going to those restaurants. So we have really only modest growth going forward. For restaurants, regular growth is a little closer to 5%. So this is still a slowing rate, even though 3.3 seems kind of a solid amount. That is it for the categories. I will hand it back over to Ken.
Thank you, Susie. Let me just try to pull all that together for you. So here you get the benefit of several years of look back of actual results. And you can see they certainly varied. The years here related to COVID's onset, which were not as dramatically negative as maybe thought when that crisis first unfolded, led to a couple of years of big double-digit increases and people spending pretty freely on everything from cars to meals, et cetera. And then we moderated growth last year. We've got a circumstance now where this will be a year of decline. We anticipate overall that revenues, when this last quarter of data is going to come in, will be down 1%. And then when we look ahead, we start to see some build back, 1.7% looking ahead into the fiscal year that's just starting come July 1st, and then getting into a more traditional or normal pattern of expected year over year growth at the 3% plus level starting out in fiscal year 25-26. I would add that when you're looking to next year, as we've gone through the various industry groups, you might expect to still see some more negative overall results in the front-loaded quarters, and a lot of the overall growth for the year is probably going to be backloaded, particularly in some of the groups that have larger tax generation concentration. But overall, this is that year kind of correction or normalizing after seeing some fairly extensive growth periods over the last 3 years. So just some additional thoughts or takeaways. You know, we've talked, and I know you're all paying attention to what is the Fed doing, and maybe by now we thought they'd be reducing interest rates. They're paying close attention to employment data, inflation indexes, and the like. So likely, if we see any action, it's much later in the year and probably fairly nominal. And the effect of that is consumers are waiting. So they're delaying or deferring larger purchases, maybe looking for cheaper alternatives, and just, I think, sensitive to really what the capacity is to spend. Households are spending, but there's definitely competing demands for dollars. And as we've touched on, kind of price points, whether you're buying a car or looking for clothing, the sensitivity around what things cost and where you can get value is definitely on the front of people's minds. If you look at terms of overall dollars, the 1% decline in this current year of fiscal year 23-24 is not going to be made up completely with a 1.7% growth in fiscal year 24-25. So you've got a couple of years there where while the cost of your services and projects and capital equipment and the like are going up at the local government level, revenues here on the sales tax front, at least, are not keeping up with those demands. And again, we touched on it a little bit. I threw a Walgreens article in the chat, but there's a lot of turbulence in the retail and restaurant sector. So it's not surprising that you're going to see more closures or contractions, whether a company completely goes away or just shrinks their footprint. That may look different in different areas of the state, but we know that's coming. And the flip side of that is, while that's a negative, there are still a lot of entrepreneurial businesses, online companies trying to get into the brick and mortar space, where you will see some expansion, likely targeting customer markets that those vendors and merchants are looking for. That will still be a bit of a positive. Just wanted to make a plug here. We do a broad range of things around revenue generation. This is a slide regarding our rental registration services. We pay close attention. There's a lot of legislation in this area, and we're focused on tenant safety, making sure landlords are tracking and paying what might be owed if you've got local ordinances or you're considering one, particularly if that's dealing with some of the Vrbo and Airbnb kinds of things. So we're happy to deal with the totality of rental registration. You can see the QR code there that's available to you. That'll take you to a FAQ page, and there's a lot of other information there that you can download. Very much appreciate your time. Want to wish you the very best the rest of the day and rest of the week. Thank you.